All right, today we are going to demystify accounting. It's basically the language that runs every single business on the planet. And believe it or not, it all boils down to two super simple questions.
So what are they? Well, it's just this. What does a business own, and where did it get all that stuff? No, seriously, that's it. Every single business, from a local delivery service to a global tech giant, is built on the answers to these two fundamental questions. And in this explainer, we're going to see exactly how that works.
Okay, let's dive in. Here's our game plan. First, we'll tackle the why, the big question behind it all. Then we'll get into the core formula that makes everything click. From there, we'll break down the 5 main types of accounts, learn the lingo of debits and credits, and then, finally, we'll see how it all comes together to paint the big picture.
So, first things first, why even bother with all this? Well, think about it. Without a common, standardized way to answer those two basic questions, business would be total chaos, right? Accounting is what brings order. It's the clear, organized system that everyone agrees on.
And here's what's absolutely wild. The answer to this huge, complex problem? It's a really elegant, simple formula. A formula so powerful, so perfect, that it's been the gold standard across the globe for more than 500 years. That's incredible.
And this is it, the accounting equation, assets equals liabilities plus equity. This is the bedrock of all modern accounting. It was first published by an Italian mathematician, Luca Pacioli, way back in 1494. Think about that. This little equation is the heart of everything we're going to talk about.
So the easiest way to wrap your head around this is to picture a classic balance scale. On one side, you've got everything the business owns, and on the other, you've got where all that stuff came from. The key rule? These two sides must always be perfectly balanced. Always.
Okay, so let's look at the left side of our scale. That's our assets. This is basically all the stuff the company owns that has value. We're talking about things you can touch, like cash, delivery vans, computers, but also things you can't touch, like copyrights or patents. If it has monetary value and the company owns it, it's an asset.
All right, now let's hop over to the other side of the scale. Where did all those assets come from? Well, the first part of the answer is liabilities. This is just a fancy word for what the business owes to other people. Think of it as claims that outsiders, like banks or suppliers, have on all that stuff the company owns.
And that brings us to the final piece of the puzzle, equity. So if liabilities are what outsiders have a claim to, equity is what the owners have a claim to. It's what's left over for them after you've paid off all the debts. It's their stake, their slice of the pie. Sometimes you'll hear it called the book value of the company.
Okay, so that's the big picture. But how does this actually work day to day? Assets, liabilities, and equity give us a great snapshot, but businesses are constantly moving, right? So to track all that action, we expand those 3 ideas and sort every single transaction into one of 5 main buckets.
And here are those 5 buckets. You've got assets, liabilities, and equity. We just met them. And then we add 2 more, income and expenses. Just think of these 5 categories as like the master filing system for every penny a company touches. Every single dollar has to end up in one of these 5.
So these 2 new guys, income and expenses, are all about tracking the flow of the business. Income, which you might also hear called revenue, is the money coming in from selling stuff or providing services. And expenses, well, those are the costs of making that income happen. Things like paying salaries, buying supplies, or running ads.
All right, so we've got our 5 buckets. We know what goes in them. But how do we physically record transactions? And more importantly, how do we do it so that our fundamental equation, that balance scale, stays perfectly balanced all the time?
Well, the answer is another 500-year-old piece of pure genius, the double entry system. The whole idea is that every transaction has 2 sides. You can't just do one thing. For every action, there's an equal and opposite reaction. It means at least 2 accounts are always affected, which is how everything stays in check.
Now, this system uses 2 words that I'll admit sound kinda intimidating, debit and credit. But trust me, they are super simple. Debit, or DR for short, literally just means left side. That's it. And credit, or CR, just means right side. Forget everything else you think you know about those words. In accounting, it's just left and right.
So, the big question is, how do you know which side to use for which account? Well, luckily there's a neat little trick for this. Certain accounts go up with a debit, which is a left side entry. To remember them, just think of the word deal. For our purposes, the most important letters are E for expenses and A for assets. Those go up on the left.
And on the flip side, for accounts that go up with a credit or a right side entry, you can use the mnemonic girls. The key ones to remember here are I for income and L for liabilities. So let's just recap that real quick. Expenses and assets increase on the left. Income and liabilities increase on the right. That's the magic that keeps the system perfectly balanced.
Okay, that's enough theory. It's one thing to talk about it, but let's see it in action. Let's meet our example company, Speedy Salamander, a delivery service. So Speedy Salamander just bought a brand new van for $30,000, and they did it by taking out a bank loan. Now, how do we put that in the books and keep everything balanced?
Check this out. This is how that one transaction keeps the whole scale in balance. First, the company's assets went up, right? They got a new van. And like we just said, assets increase with a debit on the left side. So plus $30,000 on the left. But at the exact same time, their liabilities also went up because now they owe the bank money. And liabilities, they increase with a credit on the right side. So plus $30,000 on the right. See? 30 grand on the left, 30 grand on the right. Perfectly balanced.
You know, this idea of being precise isn't just about what we record. It's also about when we record it. And believe me, the timing can totally change your understanding of how a company is doing.
So businesses usually pick one of two methods. There's cash accounting, which is super simple. You just record stuff when cash actually changes hands. But the real gold standard, the one that's required for most public companies, is accrual accounting. This is a bit different. It records revenue when you earn it, not when you get paid, and it records expenses when you incur them, not when you pay the bill. It just gives a much truer, more accurate picture of a company's health.
Okay, so where is all this going? Every single one of these transactions, every debit, every credit, every time we put something into one of those 5 buckets, it's all building up to one thing. It's creating the ultimate financial snapshot of the entire business. And this is the payoff, the balance sheet. Look at this. After a whole year of business for Speedy Salamander, it all comes together. On the left, their total assets add up to $823,000. And on the right, their liabilities plus their equity also add up to exactly $823,000. The scale is balanced. Our 2 original questions, what do we own and where did it come from, they're answered perfectly. So from just a couple of simple questions, we get this perfectly balanced sheet. It's kind of amazing, right? This elegant system cooked up 5 centuries ago is still the language that runs the entire global economy. And it's not really about the numbers themselves. It's about understanding the story that a business is trying to tell.